Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss different types of orders, bear and bull traps, and more.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us. Pennies.
Going in Raw.
Featuring Dan, Deity of Dips, and Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome to another episode of Pennies Going in Raw. Today is Wednesday, February the 16th. You had SPY gap up today. You saw it dip down to around that 437 range on Friday. We recorded before then, so we didn't really include that, but you see it pop up a good bit today. What do you think that kind of, is it just people nervous over the weekend and now we're just seeing them buy it back, or what are we kind of seeing?
Yeah, it's definitely part of that. Like, no one wants to hold into the weekend right now because of the headline risk. So if there's no headlines, everybody comes back and buys it back up. I do think that that's a pretty big part of it. And then the other part that I think is big is that, it's all these war headlines. It's one day, Russia's going to invade Ukraine on Wednesday, and then the next, day it's the next week it's, by the way, we don't want to invade Ukraine. Like, there's so much just back and forth. It gets tiring. And I think the market's kind of feeling like that tiredness, and that's why we've been seeing like these ranges. But that being said, I still do think that I really don't think that Russia wants a war with Ukraine or wants to. I think that Putin is really trying to flex his muscles right now. Get what he wants and then move on. Because there's so many other layers to this that would just get involved. And then the other thing is that Russia said that they would keep supplying Germany with oil, which is big. If they wanted to, if Russia wanted to look bad to the United States. So I think it's one of those things where you had no headline risk. Plus, again, the tide shifted with the war. And that's kind of what I'm thinking. Also, the other thing is that we really did sell off, I think, last week, and we hit like that pretty big support zone, and now we're starting to curl back up. But we still have like this kind of big range of 452 to like 440.
Yeah, I know. I think one of the most interesting things to talk about with the range is how many bear traps and bull traps there seem to be. It's hard to really play in the same direction over and over again. Sometimes you think it's about time to finally go in that direction, and it does just the opposite of what you're thinking. Do you think in a choppy market like kind of what we're seeing, you see a good bit more of these traps, or do you think it's just people reading it wrong?
I think the choppiness comes in both markets, both bull and bear markets. But inside a bear market, the one thing that I will say is that things make sense to people when they're going up. Even if they shouldn't make sense. So even if a stock is completely overvalued, everybody's like, oh yeah, well duh, like this is expected growth. They'll make excuses for the narrative to fit, if that makes sense. Inside a bear market, however, you see the exact opposite. So you'll see things get smoked that typically, so it's one thing when things are overvalued and they shouldn't be. And then it's another thing when things are now starting to become undervalued. That's when like the real panic sets in. And I think that's what we're seeing. That's what we're seeing across the board. But to your point about the choppiness and the bull and bear traps, I think that because a bear market is more volatile, that there's probably more traps inside a bear market, especially because everybody wants to believe that, that the bulls are coming to save the day, that the market's gonna, go back up. Like if you notice that, I forget who it was that we were talking about it with, but 90% of traders trade from the long side. Very few trade from the short side. And because of that, the moves to the downside are a lot cleaner. We were talking about it with Palmer. That's who we were talking about it with, was Palmer. Was that not that many traders come from the short side. And so I think that inside a bear market, the moves are cleaner, but we all want to buy, all the bulls want to buy the dip because that's what, especially inside the last 16 months, that's what we're accustomed to. So I would say that there's probably more traps inside a bear market because what if we think about it, what sets a trap, When something, if we take a bull trap, when something, let's say gets smoked and then it looks like it's going to die, one more time and then they save it, and then all of a sudden they swipe it back up to new highs and it keeps running. That's kind of what that's what we see from like a bear trap. And especially inside a bear trap where you have people actively looking to buy a dip, that's where it gets into like danger zone. Of where like, maybe the stock goes from being saved from like, ultimate disaster, big flush to, instead of being saved, it's it's back at new highs because what ends up happening is that it gets swiped back up. Maybe it's forced covers and then you have people looking to actively buy the dip. So then it's FOMO chasing. And then all of a sudden, the stock is flying through all-time highs.
Yeah, so even if we go back to like how we used to do it, like when we go for the Investopedia definition, we're saying like a false signal and you're missing out on buyers coming in whenever it's about to break that, resistance points. And you always used to talk about buying whenever it's about to break out or buying on that support. So what are ways you can kind of avoid this aside from just a stop loss? Do you have to wait for that confirmation that there are enough buyers in it, or what are some other ways to do it?
Yeah. So the biggest thing is that it's going to be really sitting there and watching the chart, and watching the tape. If you're sitting there and you have like this key level and the stock doesn't want to hold underneath the key level. So it wicks back up, it goes down and then it wicks back up, goes down and then it wicks back up. Or from the short side, you're long a stock and every time it gets over a certain, price level, it doesn't want to hold above there. So, stocks trading at $50 or your key levels at 50, it'll hit 50, 10, and then come back down, 50, 30, and then come back down. You can kind of feel it and you kind of see it on the chart. It'll wick back up and it just doesn't want to stay up there. So just by watching the chart for, any amount of time, depending on if you're a swing trader or a day trader, you can pick up a feel for that stock, especially if you've traded it before. You might remember how it acted at a certain time, or you might remember what it's like. And so when that happens, you very quickly, instead of looking for a position, you just read the action. Very quickly, you can pick up how exactly things are going to act. And then that gives you that edge. So if you have that key level and you want to go long, see how it acts and then wait for it to come back down to support. And then same thing, like, hey, the stock couldn't hold over 50. Check out what it's doing at that, 40 handle. At that 40 handle, the stock is every time that it goes below 40, it wicks back up and it's holding against 40. So now you know where your range is. It doesn't want to hold over 50, but it's holding 40 like a charm. That gives really, really good risk to reward. And in my opinion, that's how you create edge. And so, like I said, is that just by watching the tape and the action for a few hours during the day can give you a really good sense.
So it all just comes back to the personality of it. And do you think how much can the personality, like, do you like to say that it can even change on like a daily basis? Not exactly the overall personality of it, but sometimes just the way it trades, like the personality, they can kind of be like bipolar some days.
Oh, definitely. All the time. I mean, things, the whole job of a market maker is to, really screw retail when you think about it. Yeah. I mean, in short, if you go back and look at tons of different traders, and I don't mean like people, the traders, I mean like stock symbols. You'll see that some of these things wicked up, they'll be up 100% intraday, and then they'll close down only up like 10%. Like those are things that like you can look at, but then intraday, if usually it dies off by like 11 a.m. and it's kind of hanging around, that's something that can change intraday. So it's about understanding what you already know about the stock from the personality, and then taking that and applying it to your new plan. So if your new plan is to go short because it usually dies off by 11 a.m., then that's okay. You can be in there at 11 a.m., but if it starts to hold firm and kind of hold above that key level, that's when you need to say, okay, things are clearly changing from what they used to be. There's a different algorithm on there, or, there's more people buying it. This is considered better, all types of stuff like that.
All right. Well, going back to bull traps again. So I know we talked about, just watching it, making sure, checking the personality and checking the range. But when you're looking at some volume and candlesticks as it's breaking out, how much more volume do you usually look for to ensure that it kind of breaks out of the range you kind of need it to before you're really comfortable thinking this reversal is like really here, really happening?
Yeah, so I won't necessarily just buy the breakout. What I like to do is that I like it to break through a key level, come back down, test that level. So again, we use the 50 handle. If it goes up to 51, comes back down to 50, and it's holding above that 50, that's what I consider a really good breakout. Some people literally, if it's crossing 50, they'll buy that breakout. For me personally, I like to wait until I see how it reacts against that 50 on a retest. Because again, if you're watching the tape and that 50 handle, it's holding well, that's going to give you really good risk to reward ratio. So yeah, in short, basically what I'm saying is that if you want to be a breakout trader, I would wait for it to go through the resistance, kind of power through it a little bit, and then come back down and retest it.
So you're kind of totally avoiding the bull trap from even happening.
Yeah, exactly. I wanted to prove myself, and that's okay if I miss out on a little bit of gains. I'm fine with that. I'm totally okay with that.
All right. Well, our next segment, we're going to kind of go into different types of orders and also expiration. I think it, probably be easier to start off with expiration because there's only a couple of them. And when it's a good idea and when it's not, I know you have certain stocks. You're like, hey, if it ever gets here, I am 100% buying it. So I guess we can start with, we'll skip day, that one's pretty obvious, but let's go to just good till close. If there's ever one that you're just looking for at all times, most earnings reports are going to come out after hours, so it couldn't really get screwed over by one of those. Do you use good till close option or expiration ever? And if so, like kind of when are you doing it? Are there those stocks that are just, hey, if it hits this, I'm buying it?
So I'll say no, because I don't trust enough things to the long side or to the short side. The one thing that I will say is that like from the short side, I'll know fundamentally unsound companies that, if they go, to $10 a share, that means that they're worth $3 billion. Like they shouldn't be up here. So like there's the kind of like, how long bias traders have favorite runners, so do shorts. So, shorts will know that, hey, this thing can run hard, but when it dumps harder. So that's something that I think is really important to understand. But for me, I think what I usually like to do is that I usually like to set alerts on the daily chart of different stocks, so that I know that if it hits my alert, that means that it's really breaking out. It's not like one of them like nonsense breakouts. It's like the stock is truly breaking out of this zone, and that was like a pretty big range. So for instance, like Amazon held a range for like a year, literally a year. So if you set an alert on top of that range or on the bottom, that if it hits that something's going on. Like there doesn't necessarily need to be like a catalytic event, but it's breaking out on the daily chart, which is a really bullish thing.
So another one, good till close plus extended. Pretty dangerous one right there. Obviously, that one's going to go for, 3 months or 4 months, and then also go into the after hours. So you really want to get it. If it ever hits this level, I don't know what it would be. That one, pretty self-explanatory. I think it goes into GTC as well, but you are just adding a little more extra risk, seeing as it can be done in the after hours. Anything else you got for that one?
No, I mean, the one thing is that it totally depends like what you're trading. So if you're trading like a sub $1 billion company or something, obviously, that thing's not, if that thing moves 100%, that's $1 billion, but like Amazon's not going to move 100%. But we obviously have companies that move 100%, on a daily basis. So if that happens, the one thing that I'll say is that you got to know what you're trading. Like Amazon, your breakout alert could only be 10% from where the bottom of the range is, or even like the top. But if you're trading like a small cap, it could be like 100% higher than where it is. So I think it's important to understand, like, okay, what am I trading? Like when I was a big small cap trader, that's what I would focus on. Is that I would want things that are clearly breaking out of resistance. As a large cap trader, I'm now looking for things that are like, barely breaking out of resistance on a daily chart. And so because all you're looking for is a 2, 3, 4% move.
Yeah, I know. Back to the like small caps for the GTC plus extended. I mean, there were some that just followed a range so tightly and so like specifically, and you could always just set it at the top. And those pre-market, those 3 a.m. Weeble buyers and stuff would actually buy it up like 30, 40%. Obviously, we're not seeing that now, but there are definitely times where, if you're trading those small caps, you can get a good bid off those GTC plus extended orders. It's just not exactly the time right now.
No, exactly. It's definitely not the time. But that being said, I mean, there's been really good intraday movers, and so you can trade those intraday movers. I mean, like KVL was one. What's another one? SPCE was really good on the fact that they're going to start selling tickets. Like, there's really good movers out there. It's just about picking your spots. Like, that's the thing that I think a lot of people struggle with, is that everybody wants to always be in the trade. And right now, there's tons of opportunity. But like even myself, I'll climb myself into a hole, and then I'll see an A+ setup. I'll scale into it, and what would have been a really good day is just a mad day because I was down already. So I think it's little things like that are super crucial to continue to remember. That like, hey, let me be really specific about where I'm picking my spots, so that if I have 3 loser trades, it's not wiping out a month's worth of gains. Stuff like that.
All right, now getting to one that probably use a little more. Day plus extended, basically letting you trade in pre-market and after hours. Pretty obvious why you would want to do that. But when do you like to trade pre-market and after hours? I know, like, whenever the market's hot, we always used to say all the 100% pre-market runners, and that seems like such a far-fetched thing right now. Can you imagine seeing 2 100% runners in pre-market?
No, I literally could not at the moment.
It's crazy to even think about, like, that we were getting that.
Yeah. But when liquidity and outflow moves out from somewhere, it's going to somewhere else. And I think that somewhere else right now has been large caps. I mean, UPST made a 30% move on their earnings reports on the 15th. Tuesday the 15th. And so that's like the one thing is that you're seeing UPST move 30%. You're seeing RBLX move 18%. You're seeing Facebook. Sorry, I don't curse anymore. You're seeing Facebook move what, 30%? Like, it moved a few $1 billion. Like, that's wild. Like, that doesn't happen. And I know that people are going to get comfortable with large caps, and large caps won't move, and then small caps are going to start moving. Like, the biggest thing that I can stress to anybody out there is to write this down, okay? Anytime that you're feeling comfortable, be on your toes and ready for things to change. Because if you're getting comfortable, chances are I'm getting comfortable. And if I'm getting comfortable, John from North Carolina.
Get another state. There you go.
Yeah, I know. I can't think of another state other than New Jersey. So there's so many other things out there that So I think it's important to focus on that and to remember that that if everybody else is getting really good at something, then the tide is probably going to change. And I think that that's something that has always helped me inside my trading career is that mentality of like, all right, who's trying to screw me now?
Alrighty. Well, that's Day Plus extended in a very motivational way. So now I think getting into some sell types is a good one, just because there are so many of these when it comes to trailing stop dollar, trailing stop percent, stop limit, stop market, market limit. So limit and market sell, pretty obvious. Are you in this market, and in which markets do you like to set limit sells like as a price target? Obviously not exactly the swingers market right now. So you're not saying, hey, I have a $5 price target for this $2 stock. I'm setting $4.99 limit. If it hits, it hits. But when are the times you like to do just sell limit orders? And I'm not just talking as in like quick day trades that you don't want to just destroy the stock because you can't market sell it.
Yeah, I mean, the thing that I like to do is that I truly am the type of person and the type of trader that like, hey, I wanted to hit here. But that being said, like, this game is all about adapting. So there's some times where I'm trading something and I'm like, hey, either I'm selling this thing at 50 or I'm selling this thing at 7. Like, and then other times I'm watching, I'm like, all right, I want this thing to get to 30, but and then it starts to like break down underneath 20 and I'm like, screw it, this is fine. And that's where I find the difference is the difference is when I know fundamentally about the company. If I know that the company is fundamentally sound and I know this company well, I'm okay with holding for longer price target or, for bigger moves. If I am, if I don't really know much about the company, but, it's got a strong a strong technical chart, that's another time where like, I'm going to look for it to, I'm going to be patient with it. And then the other side of it is that, like I said, is that there's some days where I just wake up and I'm just happy to be green and I'm selling my stocks. Like, if the market gaps up like it did on Tuesday and my swings are up 5, 10, 15, 20%, I'm selling half. Like I'm going to sell half most of the time. And that's just to lock in profits and things like that. But like, for instance, UPST, I traded it on Tuesday after hours and I was like, hey, like I really don't want to sell the rest of this until 140. I ended up selling it like 137 or something inside the 130s. But my point is that I was stubborn with it and it worked out. But if it had started to crack underneath 120, I don't know how, I don't know how stubborn I would be, if that makes sense,
Yeah. Another good one that you should be using a lot, and especially I think it'll be interesting seeing your different ways, seeing as your big transition from swinging to day trading. The stop losses, whether it be stop market or stop limit. There are cutoff points in swings. I know you're one of the guys, like you just said, it's 50 or 7, but I'm sure there are times when it's 50 or 42. You got to have sometimes you got to have some risk management. Obviously, that's a little understated. You should always have risk management. But, and then in day trades, they're crucial. So could you kind of explain how your stop losses have transitioned from being a swing trader to day trading?
From a swinger's perspective, I think it depends a lot on the size of the trade. So if it's like I have like 20% of my account in it or something like that, then I'm probably going to have really good risk management, because that's a large percentage of my account. Now, if it's something where I believe that this company has the potential to be huge, but I'm not exactly sold completely that the management team can get it done, that's one of those situations where I'll take 5% of my account or something, or let's even call it 1%, whatever it is, and I'll throw it in there and I'll say, hey, listen, my risk management is the fact that I'm not going heavy on this. I believe that this company can be a 10-bagger, but I also could see this being a crap company. So from a swinger's perspective, I think that it comes down to position sizing, because if you're risking 5% of your account, you can be a little more lenient with it. If you're risking 20, 30, 40% of your account, you can't really be lenient with it. It's gotta work. It's got to work. Now, from the day trader's perspective, this is where picking your spots is so crucial. If you're a short, not becoming front side of moves and not screwing yourself into key levels. So not shorting into weakness is a big one. Waiting for those key levels to, break under and hold under, I think is another big one. I think that those are really important. Sorry, I'm saying a lot. From a day trader long perspective, I think that, again, key levels and picking your spots. You don't want to buy, in my opinion, you don't really want to buy breakouts. It goes back to the example that we talked about of 50. If it's just getting to 50, there are people that will buy when it breaks out of 50 or, when it touches 50. Me personally, I want to see it hit 51, 52, 53, come back down to 50, test 50, and then go higher. But that's just me. That's the way that I trade. I feel that gives me the best edge. Other people, they like to buy it with the second that it touches 50, if 50 is their key level. Now, as far as a stop loss goes, I would say that I usually keep it about 2% underneath a key level, because we'll see a lot of.
I think that's like right where most people have issues with them, because you say, hey, I want to sell at 5. Well, the market bankers know that or right when it breaks 5 at 4.99, then I'm sure everyone notices right when something breaks that, you see it drop like another 15 cents from that, from a $5 standpoint or more from a higher one. But, that's, I think, where most people are like, fuck, dude, why did I even have one? Because now it's going right back up.
Yeah. So the one thing that I like to do is that, again, I think it comes down to what the position size is. But if you are, let's just say that you have, I'm going to use the same example. You have 1% of your account, and your key level is 10. I will usually, if I have smaller size, I'll usually take the approach of like, okay, hey, if this closes underneath 10 on a full candle on the hourly, that's where I'll sell and be stopped out. So the good part to that is that you really, if it is going to go higher, the chances of you getting stopped out are very slim, because you're waiting for it to close below that level on the hourly candle.
So if you have a bigger percent in your account in there, are you following your 2% rule a little more strict?
Yeah, definitely. Because at that point, that's one of those things where, like, okay, if you have 1% of your account in and the stock goes, again, we're waiting for a close on the hourly underneath 10. So chances are that stock's going to be at like 8.59. So that's like 10% lower. Like that's your risk. It's 10% lower. So really, if you have 1% of your account in and you're risking 10%, you're risking a tenth of you're risking a tenth of a percent of your account. Basically, is what I'm trying to say. But if you have 20% of your account and you do that, you're risking 2% of your account. So, I mean, you can do the math. If you have 30% of your account and it's down 15%, you're risking that much more. You're risking 4%, or you're risking, what is that, 5%?
Oh, let's not get you into math, dude. It's like 4.5, but
4.5. But yeah, sorry, it's been a long day. So it's one of those things where, if you have a higher percentage of your account in it and you're going to be a little bit less, you're not going to follow your rules as strict, that's where you can quickly get into like, not necessarily 1,000 death by 1,000 cuts, but death by like 100 cuts, because you lose 2% of your account. You go 10 days of doing that, you're down 20%. That quickly adds up. Yeah, so that's the way that I like to handle it.
Like if you ever have like a day where you lose 1% of your account, you're like, damn, I can only do this 99 more fucking days.
Yeah. Yeah, exactly. So, for me, it comes down to position sizing, and like I like to go heavy. I do, but you got to still have manage your rules. But the one thing that I will say is that I do enjoy kind of taking like a flyer, like UPST. I took a flyer on their earnings report, and the second the earnings report came in, without even really reading them, I slapped it, and so it wasn't big size. It was about it was small size, but I said that I was going to have a little bit more room on this than what I typically would do. Like I wanted this to be a nice hit, using smaller size.
All right. Well, the last types are trailing stop losses. There's percent and dollar amount. I think they're super interesting and also super helpful, but I don't think enough people use them. I don't use them as much. I'd like to use them a little more. I think the concept of them is such a smart thing. Hey, I'm up. I'm not going to lose money on it. But if this thing drops another 50 cents from its high, then, whatever, I'm out, because I'm already up X amount and I'm not going to lose more than this. And that's, what a way to do it. And you can use your support levels with that to kind of and adjust it as it goes.
Yeah. No. And I'm also, another thing that a lot of people do, to your point, is like, they have like a max dollar loss.
Yeah. There's a percent dollar amount. Yeah.
Yeah. And the one thing is that, like, I'm totally fine with that. Just I'm terrible with numbers. So like, if I only want to lose $5,000, but like if you only want to risk or let's say that you want to risk $500, like you can't be putting in like $100,000. You're like, yep. If I get down 500, like I'm selling it. Like you have
the way it works is like it goes up as the stock goes up. So if you put a 50-cent stop loss on a $5 stock and it goes to 5, and if it's whenever you buy it at 5, your stop loss is at 450. As it gets to 550, your stop loss is now 5. As it's 6, your stop loss is now 550.
I understand how trailing stop losses work, you dork. I'm just saying, it popped in my mind that
if anyone didn't understand, now you know. You're welcome for that.
Yeah, thank God. No, I like trailing stop losses. The only thing is that, I think it comes down to, on one hand, it's like, do you do a market order if it hits that trailing, or do you do a limit? Because the market order, you might get filled at a really terrible price and have some serious slippage, especially if you have a big size. But if you do a limit, and like let's say like the CFVI news that came out, that Joe Rogan wasn't, declined their offer or whatever, in that same token, if you did a limit, you'd be screwed. So what do you usually do?
Market has less risk.
I mean,
little bit of slippage versus holding a bag. What the fuck? I think that's pretty easy.
Yeah, I guess. But again, that happens 100 times.
Okay, so I guess we'll kind of dive back into these later, because when Hugh can find out what a trailing stop loss is, and then we can come back with a real
thank
knowledge
God
of this.
Yeah.
So lastly, we have some earnings reports coming up this week, mainly retail. Do you know? You want me to go over them?
Yeah, go over a few.
All right, so big ones are going to be NVIDIA, Walmart, Airbnb, Shopify, Marriott, and Roblox. There's a few more, but yeah, what do you think people should be looking for this week as they come out with their earnings reports?
So when reading an earnings report, the one thing that I think is really important, now, if we take something like NVIDIA, okay, chip shortage has been a big thing, obviously. Like we hear it all the time. So what you're going to want to hear is that I think it's going to decide a lot on future guidance. You know, like how does NVIDIA see themselves holding up inside the next 5 years? You know, what is their growth plan? That's something that I think is really important. I don't necessarily really care too much about NVIDIA's, numbers per se. Like obviously I don't want, like if they're pretty much on par, I'm fine with that. I don't really expect like a huge move, but the one thing that I will say is that for everybody else, I want to see how much just my standard fundamental analysis is usually I want to see how much cash they have, what their burn rate is, what's coming up from a catalyst standpoint, and what their future guidance is. That's what I want to know. Okay, that pretty much tells me, or at least gets me on the right track for
power rank those future guidance.
Yeah.
Power rank them.
Number one would probably be,
judging by what I've seen on a lot of stocks, future guidance is pretty damn important.
Future guidance is important because of the last 15 months. But typically, in my experience, I believe that future guidance plays a role only if there's a dramatic change. So like, hey, we're not going to deliver, like if Tesla came out like, hey, I know we delivered 100,000 cars this year. Like we're only delivering like 10,000. Like that's like something that, oh yeah, okay, fine. It matters. But everybody else, if it's pretty much like everything's on par, it's fine. For me personally, I want to see what their cash is and what their burn rate is. That's like number one for me. Because especially if I'm trading a growth company, and Tesla's a growth company. I don't curse.
Dag nabbit.
If Tesla is a growth company. So if Tesla comes out like we just talked about and says that their future guidance is going to be terrible, I want to know about that. Now they're in a much better position, obviously financially and fundamentally, but a few years ago, it was really important to know how much cash they had on hand because they were burning through cash like nuts. In fact, I believe that Tesla was saved 2 or 3 times from like bailout loans. And Elon Musk, like the reason that Elon Musk is so rich is because he was bailing Tesla out. Every time that they needed cash, Elon Musk was opening up his own wallet, and that's how he ended up acquiring
PayPal.
So much. Yeah. And that's how he ended up acquiring so much of the company. So I think when you put that into perspective, it's really important to understand, why, what is going to make the company run and why, and what the company is running on. And so that's obviously cash. So you want to know the burn rate. And then also you want to be able to see what are the potential red flags coming up. So, that's when I'll just kind of skim through, usually they'll talk about, future guidance, forward-looking statements, especially if there's a conference call. I usually like to listen to the conference call. And the conference call will tell you a lot, because one of the things that I think a lot of companies try to deceive investors with is that they try and hide things underneath these conference calls. Like, hey, you hear it directly from me, and it won't be so bad. Like let me deliver the news over the voice to try and calm you down. And I think that that's just so stupid. That's just my personal opinion.
All right. Well, I think for next week, we do have some FinTwit drama playing out, so we can go over that then. And till then, we hope you guys enjoyed the episode. Feel like there was a lot of good info out there. So, yeah, let us know what you think, and hope you guys have a great rest of your trading week, and we'll see you Sunday.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.